Hey, what's up everyone? Here in this channel, you'll find everything you need to know about investing, real estate, stocks and crypto, and how to get started investing from A to Z. In this video today, I will be sharing with you the advantages and disadvantages of growth investing. If you're into that sort of content, please subscribe and hit the like button and the bell notification so you don't miss a video. Growth investing is a popular investment technique and it's one that Dave Ramsey recommends. What precisely is growth investing and how does it compare to others? Is this a technique you should be implementing? And by the time you retire, taking advantage of the investing technique that makes the most sense for you could mean the difference between hundreds of thousands or even millions of dollars. It's usual for people to overlook the type of investment they're making, especially if they're in a 401k. It's a mentality of set it or forget it. They may not even be aware of what they've invested in or how their returns compare to the overall market. Take a look at the advantages and disadvantages of a growth technique to ensure you don't miss out on millions of dollars. Today, we'll talk about money, personal finance, and investment. If you want to have a better financial future, make sure to watch this video until the end. So what is the meaning of growth investing? Growth investing is a technique that focuses on a company's future earnings potential and capital appreciation. Investors often seek out high-quality, well-established businesses that have a strong reputation of high growth and are likely to continue growing at a rapid rate. Using a combination of fundamentals and other factors, investors make a prediction for the future. Investors can predict that it will still continue growing reasonably fast. Take a look at Walmart, which is a much older company founded in 1962. And you can see how growth has slowed because it becomes so large. There's a Walmart in almost every town. There's only so much more they can do to increase profits. Returns are generally higher. The single largest advantage to a growth investing technique is the high returns. Earning great money is the point of investing, right? Over a long period of time, growth investors are generally able to outspace the returns of broad market funds, and even those like the S&P 500, for example. This presents a fantastic opportunity for younger people who have smaller portfolios that are focused on increasing their nest egg as opposed to preserving their capital. If you have $10,000, you're probably not worried about losing it. Instead, you're thinking about how to increase it quickly. Investors' returns become less important as they get older, while stability becomes more important. When a person has a multi-million-dollar portfolio, capital preservation is usually their first goal. This is why many older people invest a large portion of their savings in bonds, which are more stable but give low returns. Risk is often higher in bonds. It should go without saying that a larger reward usually entails a higher risk. No one wants to spend their hard-earned money on high-risk investments that could result into nothing. The good news is that if you pick quality investments, the higher risk will work in your favor over time. When the stock market falls, it's very usual for new investors to become worried. They consider selling as a method to limit their losses, when in reality, chances are that it's already too late by the time they sell, and they could very well be doing so at the bottom. If you're able to tolerate market fluctuations without the temptation to sell when things are red, history shows that you'll be rewarded. This is much easier to do the younger you are, but becomes less tolerable as you age. A 50% drop or more in portfolio value for someone in their 20s and 30s would likely have no impact on their day-to-day lives, since the average retirement savings of someone 30 to 34 years of age is just under $22,000. That would only mean a dip of $11,000. Someone nearing retirement or who was already retired would probably want to avoid swings at extreme at all costs. Could you imagine stomaching a 1 million or more dip in your retirement savings? There are little to no dividends. Growth investments pay little to no income, which is a disadvantage in the eyes of many investors. The reason there are little to no dividends is because the companies choose to reinvest their profits by continuing to grow the business. Some companies pay high dividends because they feel that they can no longer reinvest the entirety of the profits within the business. Instead, it's better distributed to shareholders. That's one reason why dividend and income-paying stocks tend to grow at lower rates. Many dividend stocks' growth has slowed, the same way as Walter Mart's did. Instead of receiving dividend payments and having to choose whether to buy more shares or spend the money elsewhere, some investors prefer that the company maintain the earnings and invest it themselves. Why would they want cash when the corporation could put it to better use? You can manually reinvest dividends or use a dividend reinvestment plan. But it isn't the same as the company's board of directors focused on growth. When a corporation starts paying a dividend, it is considered to have reached a growth halt. Dividends, on the other hand, can attract new investors and keep shareholders happy during periods of flat or even dropping stock prices. At retirement, growth stocks will provide way more money. What's really shocking when it comes to growth investing is the difference in the amount of money you could end up with. Over a career of investing, just a 1 or 2% difference in your overall returns can be shocking. Take, for example, someone who begins to invest in their mid-20s with $1,000. If they invest an additional $6,000 per year until retirement, or for about 40 years and achieve an 8% annual rate of return, they'll have just over $1.7 million. For reference, the S&P 500 has an average rate of return of 10% per year over many decades. Now, if they were able to earn a higher rate of return by investing in high-growth alternatives and earn a 12% return for the same time period investing the same amount of money, they would have a staggering of $5,247,000. That difference of $3,547,000 could allow you to live a much different lifestyle during retirement. In fact, it would provide about 3 times the amount of retirement income. Consider that an individual earning $60,000 per year for 40 years will only earn $2.4 million before tax. While returns vary and many would argue that 12% isn't achievable, the point is that the returns make an astronomical difference. Commonly, 401k investors might not even know what they are invested in, what their portfolio performance is, and how much it will impact them in the long run. They will gladly spend 40 hours or more per week working for $60,000 per year, but won't take the time to address their portfolio, which will have a greater financial impact on them in the long run. It doesn't have to be complicated. An example of a great growth ETF is the Vanguard Growth ETF or VUG. It holds large-cap U.S. companies similar to what you'd find in the S&P 500, except without slow-growing stocks. There are currently 287 holdings consisting of well-known names like Visa, Nvidia, and Home Depot. The average annual return of VUG over the past 10 years has been just under 18%, while Vanguard's S&P 500 ETF averaged just over 15% in the past 10 years. Growth has been better than the S&P 500, but the dividend yield is less than 0.5%. An index like this is an excellent approach for someone who wants to achieve a sizable amount of growth with a reasonable amount of stability. Growth investing is perhaps the best way to achieve great returns and compound your money over a long period of time. If you can handle any extra volatility, you will be rewarded. So there are plenty more tips and tricks that we will cover in our channel, but we hope you enjoyed this video. If you did, be sure to like and subscribe. Thank you for watching, and we'll see you on the next one.